Joining us now, Mark Grant, Chief Global Strategist at Colliers Securities. Mark, I was reading your notes from last night, and it was following the arranged marriage that we saw. You said it's a good sign that the futures are up a little or okay. Then I got up this morning, the futures were down 350, and I said I'm going to have to ask Mark Grant something totally different about this, whether this is working. Now they're back down 28 points or so. So it's a fluid situation. Do you think things are stabilizing at this point, in your view?
No, Joe, I don't. I think this is an incredibly messy situation, and I think it's going to get worse. You know, I have the advantage. I've been on Wall Street 49 years this coming April and seen a lot of stuff. Let me start with what's going on in Europe. The UBS says they're not going to pay the AT1 bonds or the COCO bonds, which are higher ranking than the equity, but they're going to give the equity holders some money. And there's going to be massive lawsuits, in my opinion, because of this. And the takeover of Credit Suisse also raises issues in the United States. For instance, Credit Suisse has 3 exchange-traded notes covered by the SEC, writing covered calls on gold, silver, and oil. And we have no clue what's going to happen to those securities. Then in the United States, you know, First Republic just got downgraded twice in a week. There's, yes, a takeover of some of the banks by the First Community, but there's the fallout in terms of Credit Suisse and their other obligations and their liabilities with other banks is going to be a mess for the United States as well as for Europe. And I also think that the banks in Europe are going to get hit. I think the situation, Joe, is so complicated that most people don't understand it and don't understand that the potential liabilities that both American banks, bondholders, and European banks face. It's a mess.
And you tie a lot of what we're seeing to the original sin, the original mistake by central bankers, including the Fed, at staying at zero for too long.
Yeah, let me address that issue, Joe. Yes, I think they stayed too long. No question there's been mismanagement at a number of these banks like Silicon Valley Bank. But part of the problem, in my opinion, is the Fed stayed at interest rates that were way too low for too long, ever since the financial crisis of 2008 and 9. And then they made a second mistake, which is raising interest rates much too quickly and too aggressively. And that is feeding into the financial stability of many of the regional banks in the country. And I think, in my opinion, the Fed's smartest move, and a number of people at the Fed get my commentary every day, and at the Treasury Department, I think the smartest move is to stop. Just stop raising interest rates, let the world cool off, let the markets cool off. Then if you want to come back in and say, let's try to get back to 2%, fine. We're at 4.5% or 5% now. And there's no question in my mind what the Fed needs to do is just stop.